Hello, it's Drunky Cocamo. I've been asked to provide a series of economic lectures on the lindencollar.com website. The stock market. Why does everyone cheer when the stock market goes up and freaks out when it goes down? Are the fortunes of the unfortunate really linked to the fortunes of Wall Street financiers, or is there in actuality a certain component of inversely proportionate effect on the people who have no stock market holdings? To me, Drunky Cocamo, the rich company owners have linked the fortunes of many retired persons to their fortunes. I remember the beginning of and the proponents of investing in stock market with pension funds. It was going to be all wonderful, all rich together. It is probable that about 1/3 of retirees are supported by money which is withdrawn from accounts and funds linked to the stock market. At least half of Americans are attempting to accumulate funds for their retirement through the purchase of stocks or stock market-based funds. I see the possibility for many persons' retirement plans being ruined. I don't see any presently unpensioned persons who would suddenly have pensions. The stock market has delivered little or nothing to increase pensions through investment in stock. The stock market has really not gone anywhere in 10 years or more. Let us get down to the inner workings of the economics of stock market increase. There is a business, it has sales, means of productions or other valuable product, and it can create wealth for the owners. If the business has changed little in real property worth and what it can produce, stock price increases are purely inflationary. The exception would be if a company actually found gold or the equivalent or managed to increase output and sales. All other increases are purely inflationary. Let us examine what the effect would be on persons who had invested in the stock market and were successfully extracting their earnings and spending them to support themselves. The inflationary aspects of stock market increase would increase prices and costs. Some lucky stockholders would benefit more by the rise of their stock than by the disadvantage that the inflationary aspects cause. Some not so lucky stockholders would benefit less than their costs increase. In conclusion, 2/3 or more of present retirees would lose due to inflation and would probably not receive any increase in earnings due to stock market increase. The sole effect of large rises in stock prices or property values is to dilute the value of money. Anyone who must consume goods and services at the more expensive rates which diluted money value causes will not benefit from rising values, costs, and prices. Only those who possess or earn an excess of money well beyond their needs will benefit from the inflation. With the Chinese manufacturing so cheaply, there was one of those ameliorating circumstances to the inflation which has occurred in the last 40 years. Somewhere back in the 50s and 60s, prices remained stable and wages did also. The 40-fold inflation of cost and values of property means little but that there will be uncertainty, volatility, and impediments will arise which prevent saving, building, and planning for the future.